There's a really good quote by Sir Edmund Hillary. So Sir Edmund Hillary, I believe he's a Kiwi, was the first person to fully climb and summit Mount Everest. And they were asking him, there was obviously a lot of questions, like how did you do it and all these things. And he had this great response, which is he said, it's not the mountain that we are overcoming. It is ourselves. And to me, that is very symbolic and representative of trading, which is that you're not conquering the markets. The markets don't even know who you are. They don't care who you are. They never will, unless, even if you're Soros, the market will always be bigger and, comprise of bigger things. But you're not conquering the market. You're not conquering trading or strategies. You're conquering yourself and your own mindset and your own limiting beliefs and fears and doubts and confidence or lack thereof. You're conquering your own inner obstacles. And when you remove those inner obstacles, when you transform them, when you change them in a real fundamental way, then that's when you'll start to experience not only success in trading, but you'll experience a confidence and a wisdom that can and will last you the rest of your life. And it will be a part of everything you do after that. And so that is my kind of final thing, which is that you're not overcoming the mountain or the market, you're overcoming yourself.
Focus on not losing money, and do not focus on making money. You need to look at things opposite of the way that you want to. So focus on managing your risk and stop trying to figure out how many pips or ticks you can make every day.
Patience. Like what I was saying, you want to jump in, you want to start making the millions tomorrow. You need to be patient. If you really want to do this, it will happen, but it takes time. And that's it. And commitment. Like I said, you have to have the patience to know that it will happen, but you need to commit to the process and enjoy the process, because it can become really enjoyable, almost spiritual. So that's it.
Sounds good.
Patience, commitment, enjoying the process.
You want to focus on a development plan. Actually have a plan of action in place. Actually have a starting point, plan of action for development, and naturally so then from there it will take a natural course. So it will change and move, and then that way you will gravitate toward what your psychological profile becomes more acquainted with or has a higher level of aptitude for. So that development plan will actually help to connect the two. So I highly suggest don't do things randomly. Really establish a development plan, and then your trading model will be a result of an effective development plan.
Simplicity, simplicity, simplicity. Don't let your emotions drive decisions. And there's so much noise in this business. Let the data, let your historical data, your back testing, let the results drive your decision-making process. Okay. I think this trade's going to do well, or I like this setup. Those are all emotions. Those are all emotional verbs. Be statistical. Be data-driven. All right. The answer to your question in 2 words: stop thinking. Don't think too much in this business. Keep it simple.
I would say the biggest thing that you can do for yourself as a trader is to, risk a fraction of your trading account. Risk 1% on each trade, right? If you can stick to this one simple rule, I believe that you can actually, survive the learning curve, right? 1% on each trade. If you have $1,000, put in $10 on each trade. I don't think you can trade a lot of markets with $10, possibly only the Forex markets. But yeah, stick to 1% on each trade, right? Risk 1% on each trade. You can have, 10 trades, 10 losing trades in a row, but it's only a drawdown of 10%, and it's something that you can still, overcome. So I think that is the best advice I have for traders, right? Risk small, keep your tuition fees really small, and once you've got the aha moment, then it's all a matter of scaling up accordingly.
Manage the risk.
It's simple. So how do you do that exactly?
Never risk more than 1% of assets under management on any specific trading idea, and dampen the risk in front of event risk days or event risk moments, and be cognizant of correlations between assets, positively correlated assets, dampen your exposures because of that.
I remember in the market decline around 2002, CNBC ran some sort of poll that said, "Why do you think you've lost money in this market?" And they had items like corrupt analysts, corrupt CEOs, bad advisors, bad market, and a few other things like that. Well, every one of those have in common blaming somebody beside yourself. They could have asked, I didn't have a system, or if I had a system, I didn't understand position sizing, or I didn't realize that different systems trade under different market types, and you have to have a system if the market type changes. I didn't have any understand position sizing. I didn't have good exits. Or I had all this in place and my psychology was terrible. Now, if you had those as reasons, that you could fix what happened. But if you're blaming other factors for your lack of success other than yourself, then you're going to repeat the same mistakes over and over again.